Throughout U.S. history, financial crises have led to massive bank bailouts funded by taxpayers. These bailouts, often justified as necessary to prevent economic collapse, have stirred debate over whether they truly benefit the public or simply rescue large financial institutions from their own risky decisions. From the Great Depression to the 2008 financial crisis, bank bailouts have cost taxpayers billions. Here are the top 10 most expensive U.S. bank bailouts in history. 1. The 2008 Troubled Asset Relief Program, TARP, $700 billion. The most well-known bailout in U.S. history, TARP was created during the 2008 financial crisis to prevent major banks from collapsing. The government injected billions into financial institutions, including Citigroup, Bank of America, and J.P. Morgan Chase. While some funds were eventually repaid, TARP remains one of the largest taxpayer-funded bailouts ever. 2. AIG Bailout, $182 billion. American International Group, AIG, was one of the largest insurance companies in the world before the 2008 crisis. When risky investments caused its near collapse, the government stepped in with $182 billion to stabilize the company. AIG later repaid the funds, but the bailout sparked controversy over excessive risk-taking in the financial industry. 3. Citigroup Bailout, $476 billion in total aid. Citigroup received one of the largest bailout packages in U.S. history, benefiting from both TARP and additional federal aid. The bank received multiple rounds of funding and guarantees, leading to taxpayer exposure of nearly $500 billion. Citigroup eventually repaid most of the money, but its rescue remains a key example of government intervention. 4. Fannie Mae and Freddie Mac, $187 billion. Government-sponsored mortgage giants Fannie Mae and Freddie Mac played a major role in the housing market collapse of 2008. When their losses mounted, the government provided $187 billion in aid to prevent the mortgage industry from crumbling. Unlike some other bailouts, these entities remain under government conservatorship today. 5. Bear Stearns Bailout, $30 billion. Before the collapse of Lehman Brothers, the government orchestrated a $30 billion rescue of Bear Stearns, one of Wall Street's major investment banks. The Federal Reserve facilitated its acquisition by J.P. Morgan Chase, fearing a domino effect in the financial markets. This bailout set the stage for larger interventions later that year. 6. Bank of America Bailout, $45 billion. Bank of America was heavily impacted by the 2008 crisis, especially after acquiring struggling investment firm Merrill Lynch. To stabilize the bank, the government injected $45 billion through TARP, along with additional loan guarantees. While Bank of America eventually repaid the funds, its bailout remains one of the most significant in history. 7. The Savings and Loan Crisis Bailout, $125 billion. During the 1980s and early 1990s, hundreds of savings and loan institutions failed due to risky lending and financial mismanagement. The government created the Resolution Trust Corporation, RTC, to manage the crisis, costing taxpayers an estimated $125 billion. This bailout reshaped the financial industry and led to stricter regulations. 8. The Continental Illinois Bailout, $9.5 billion. In 1984, Continental Illinois, one of the largest banks in the U.S., faced insolvency due to bad loans. The federal government stepped in with a $9.5 billion bailout, effectively nationalizing the bank. This marked the first major case of a too big to fail bank rescue, setting a precedent for future bailouts. 9. The Federal Reserve's 2008 Emergency Loan Program, over $1 trillion. Beyond TARP, the Federal Reserve provided over $1 trillion in emergency loans to struggling financial institutions during the 2008 crisis. This included support for Goldman Sachs, Morgan Stanley, and other major banks. While these loans were eventually repaid, they highlighted the immense government support required to stabilize the financial system. 10. The 2023 Banking Crisis Bailouts, estimated $140 billion. In 2023, the sudden collapse of Silicon Valley Bank, SVB, and Signature Bank led to government intervention. The Federal Deposit Insurance Corporation, FDIC, and the Federal Reserve took emergency steps to protect depositors and prevent wider panic. While these actions prevented a full-scale banking collapse, they raised concerns about ongoing financial stability. Bank bailouts have played a crucial role in preventing financial disasters, but they often come at a high cost to taxpayers. While some funds have been repaid, these interventions highlight the risks associated with excessive speculation and poor financial management. Understanding these bailouts helps us recognize the importance of strong regulations and responsible banking practices to avoid future crises.